Now I'm going to teach you about the actual mechanics of these offerings. That's how you know how to do them. And I'll also show you how you can spot the ones that are the best deals. Not all are good. I'm going to show you how you can find the ones that allow a quick, tidy profit. First off, what are you looking for when it comes to these deals, these secondaries? You want to be able to find the secondaries that allow you to try and make fast but still significant gains in the stocks of companies that, frankly, I don't even care if you like them or not, all right? To use secondaries as opportunities to buy stocks that you would genuinely want to invest in at a nice discount. In other words, I'm saying I don't care if you like them or not. If it's at a discount, we're in business here. Unfortunately, although many recent secondaries have turned out very well for the buyers, you just can't assume that the next one will work. That is not rigorous. So keep in mind that not every secondary offering is a fabulous opportunity to make a fast gain. But at the same time, don't assume that past performance isn't predictive of future success, because in this case, we can learn a lot from the secondaries that have been the most profitable for their investors. So many of these offerings have effectively amounted to what I call huge giveaways, where in a matter of days, the stock rises far above the print price. Remember, that's the price where the secondary happens. I need you to know some of the jargon so you can sound smart enough. It does matter when you get on the phone with these brokers. The price you would pay for the stock if you got in on the deal is called the print price. So what do you need to know in order to find the best opportunities among the many secondary offerings that companies are now doing? Let me tell you how I would approach them back at my old hedge fund where I ran $500 million and how I teach you to analyze them and getting back to even. First of all, I would often buy things, I know this is counterintuitive, that I didn't initially care for, simply because I wanted to buy merchandise at a discount to a hot market that had moved up very, very far and fast. It's not like clothes, where something's discounted and suddenly you buy it even though you don't like it. No, these are stocks, and you're not going to have to wear them. Don't worry about it. When it comes to secondaries, I cared a whole lot more that I liked the price where the stock was being offered than I did about what was actually being offered, because it was most likely going to be a trade. A trade, meaning I was going to take the gain. A lot of companies that are pretty ho-hum have done secondary since the generational bottom in March of 2009, and they did it in order to raise money to pay down debt, or in the case of the banks, to pay back the government. And you would have made money in almost all of them. To begin with, you have to watch what's known as the news tape in order to hear or read that a secondary has been filed. A lot of companies don't even get press, okay? So you have to really look in the what's known as the agate type in the papers, Yahoo Finance, and CNBC.com. You'll get that. It helps to have a full-service broker, though, because that broker will alert you to these deals because he gets big payback when he does them and aid you with each secondary. Don't worry that he makes some money. You can make some money, too. It's possible to play them with your own electronic broker, but it's not as easy. Second, I don't want to minimize the need to do the sort of basic homework that we always have to do before buying a stock. Do you know that I would never, ever buy the stock of a company that I hate or a company that I don't trust, even at one of these discounts created by the secondary? But when the pricing on a piece of merchandise, notice I use that word merchandise because there's just stocks, when the pricing changes, I change my mind about the merchandise, to paraphrase the late great economist and investor John Maynard Keynes. When a stock gets much cheaper, it makes sense to become attracted to something that you might not otherwise have been interested in. After we assess the discount to the last sale that we're getting thanks to the secondary, we have to check out the demand for the new supply of the stock. How many people want it? I want you to analogize, think of it like this. This is like trying to get tickets to a play. Is it hot enough? If it's too hot, then we can't get in as many seats as we want. Can't get enough. So the deal's not of interest. And if it's not hot, we get all the shares we want, then we're not interested because we'll probably stink up the joint. If it's just right, meaning that the broker calls us and says the big guys are coming in at this level, it's tight, there won't be much around, then you got a good secondary you can sink your teeth in. For this information, though, I do have to rely on a full-service broker to help me out. They're the ones who can check on demand. They can just pick up the phone and see whether there's really a lot of interest, see how many buyers there are out there, how much real interest there is at a given price level, by checking with what is known as the syndicate desk, which places the stock. At the right price, the brokers know that the big institutional money managers will buy the secondary and then keep on buying in the open market, which is what drives the stock up after the print price. If you're dealing with a full-service broker, then you want to hear that the deal is tight as a drum, as a 55-gallon drum, even if that's dangerous. No flippers. Meaning the only real buyers are large institutions who have pledged to hold the stock. Even then, when we put in, we still leave a little behind in case the secondary doesn't go as well as we think. You never want to buy all at once, even in these secondaries, even when it looks like you're getting in on a bargain basement level. So, let's say you want to buy 200 shares of a deal that looks very attractive. We only buy 100 shares. Then we see if it breaks the print price. Breaks meaning it goes below it. Now, that often happens because the stock wasn't softened enough. These are all important terms. I need you to get good at this. This is a concept, softened. Think of it in terms of like World War I or World War II. When we softened the other side up with artillery fire before we charged, the other side, the existing shareholders, have to be so beaten down that the sellers have dried up. And the only people left owning the stock are the diehards, the comatose, and the buy and hold fanatics. And finally, we want to be sure that after the secondary is priced and trading, the broker will support the bid by buying stock itself to stabilize the market. Buy! Stabilizing means, this is another technical term, I'm sorry, that the brokers are trying to keep the stock at one level with their buying until other buyers come in. Again, a full-service broker can intimate to you what's going on and whether there's a bid underneath. Here's the bottom line. If you're going to make money playing secondary offerings, you have to care as much about the demand for the stock as you do the fundamentals of the company, except when the fundamentals are just plain awful. But unless you decide that you like the stock at any price and you don't mind losing some money, not a common attitude here in Cramerica, you need to have your broker help you gauge the demand for stock. You can't do this yourself. If you don't have help, you might just want to take a pass because it's probably too hard. But if you do have help, if you know the price is right, if the discount from the last sale is huge and the discount from people before people knew about a deal is even more gigantic, if you know the stabilization is there underneath and the shorts will need to cover while the longs are lapping it up, then, my friend, you got a secondary you need to get in on.